Happy Thursday out there, folks. This is Darius Dale here to present our macro minute for Thursday, August 25th, 2022. Starting with markets, we have stocks up this morning, commodities mixed, crypto mixed, dollar down, global bond yields down, market moving headlines. So production doesn't always equal income. We got the second revisions to GDP for the second quarter GDP today. We got the government's main measures of growth pointed in different directions throughout the first half of this year. So underpinning the debate about the health of the U.S. economy. So real GDP, which is the total value of goods and services produced in the economy, decreased at a 0.6% annualized rate in 2Q. That reflects an upward revision to consumer spending and compares with the previously reported minus 0.9% contraction. However, the other lesser known measure, official measure of economic growth known as gross domestic income actually rose at a 1.4% pace in the second quarter after increasing 1.8% in the first 3 months of the year. So no actual recession yet. Our second bullet here. Theoretically, GDP and GDI, GDP and gross domestic income should be roughly equal, but in reality, they tend to differ, especially in early estimates. But the current gap is particularly large in terms of 1.4% growth for GDI and minus 0.6% negative growth for GDP. The official arbiter of recessions in the U.S., which is the NBER, they have their business cycle dating community. They use the average of both measures along with a range of other economic variables to make a recession call. The average GDP and GDI rose 0.4% in the second quarter, increasing from a 0.1% increase in the Q1 period. So we're moving away from the NBER timestamping the first half of this year as an official hashtag actual recession, just based on this the second revision to Q2 net gross national income accounting data. Anyway, shifting gears here to Asia. More stimulus drops in the bucket out of Beijing. So China stepped up its stimulus efforts with a further 1 trillion yuan, which is roughly 146 billion US dollars of funding, largely focused on infrastructure spending, support that likely won't go far enough to counter the damage from repeat COVID lockdowns and a property market slump. The State Council, China's cabinet, outlined a 19-point policy package on Wednesday. That sounds like a lot, but it still drops in the bucket, including a 300 billion yuan that state policy banks can invest in infrastructure projects on top of 300 billion yuan already announced at the end of June. Local governments will be allocated 500 billion yuan of special bonds from previously unused quotas. So we're talking about 1.1 or 2.1 trillion yuan here, which is roughly around 1.5% of Chinese GDP in terms of all these incremental measures. The State Council repeated its prior guidance in saying the economy will not, quote, be flooded with excessive stimulus, and that China won't overdraw on the room it has to take more policy action to protect longer-term growth, reiterating its relatively cautious stance that officials have taken towards stimulus this year, stance that, of course, is appropriate in an economy that keeps getting turned on and turned off like a light switch due to President Xi's zero COVID policy. I thought the word overdraw was particularly awkward in the context of some of these failed bank runs, if you will, from Chinese citizens trying to get their money out of the banking sector and ultimately failing at that. We're seeing, continued pushing back against paying mortgages, et cetera, et cetera. For now, that sort of crisis in the property sector and the property market in China has been relatively contained and offset by some of these policy initiatives, but certainly we are not seeing the kind of stimulus that you need to see and the kind of relaxation on zero COVID that you need to see to perpetuate a broad-based reflation of the Chinese economy that is trending and sustained, and ultimately something that could be really supportive for the broader global economy. So no real changes to our views on China in the advent of these headlines. And we also saw the Shanghai Composite up 1% on this news. It's flat month over month. So clearly the market there not celebrating this with the same kind of ferocity and fervor that you might expect if this were, in fact, a big stimulus announcement. Getting into our volatility adjusted momentum signals and probable ranges. U.S. dollar index, that is bullish fans, bouncing off the upper bound of its probable range. Here you got about percent of upside versus 1.5% of downside. Gold bearish fans, bouncing off towards the lower bound of its probable range with about 2% of downside, 1.5% of upside there. 10-year nominal treasury yield, that is neutral VAMs there, still at the upper bound of its probable range. High yield credit spreads, bullish VAMs, somewhat in the middle of their probable range. S&P 500, that's bullish VAMs. bouncing off the lower bound of its probable range heading into Jackson Hole. We talked about the setup, particularly from through the lens of our crowding analysis this morning in our leadoff morning note. Maybe surprising. We also talked about the range of outcomes that we could hear from the discussions surrounding monetary policy from the various policymakers. So if you wanted a preview on that, definitely go check out our leadoff morning note today. But anyway, S&P 500 got about 4.6% upside versus 0.5% downside in its probable range. VIX bearish fam still overbought heading into there. So obviously these two things together tells you what the setup is from the perspective of kind of the risk we see to asset markets over the near term coming into and out of Jackson Hole. NASDAQ 100 bullish FAMs bouncing off the lower bound of its probable range is still more or less oversold there with 7% immediate term upside. Russell 2000 bullish FAMs not quite oversold, but about 1.2% downside, 6% upside there. Bitcoin bearish FAMs minus 5% downside, 9% upside. Ethereum bearish FAMs, middle of its probable range as well. Fair fight there. Shanghai Composite bullish FAMs, breaking out the bullish. We'll see if it holds, but certainly, and on the decline in volatility, the price signal in the BAM signal has been bullish for a while now, but the volatility in recent weeks and months has catalyzed that neutral BAMS transition, but we're seeing the volatility tone down. We'll see if that's sustainable in terms of this new bullish BAMS reading. But the Shanghai Composite's got about 60 basis points of downside versus 3% of upside there. WTI crude oil, neutral BAMS more or less in the middle of its range. Ag bearish fam still overbought there. Still a lot of strength. We talked about this in the leadoff morning note in terms of, we saw, this was phase one of the monetary policy, global monetary policy regime, which, global central banks had to catch up to commodity markets and more importantly, money markets and fixed income markets in terms of what they were pricing in for policy tightening in 2022 and 2023. Phase two of this is markets pricing in kind of the dovish pivots and the degradation of demand associated with all that tightening. And now phase three could be, we think the probability of, rising into phase three continues to rise, which is policymakers having to push back on dovish expectations that are a little bit too dovish. We think the world is entering a higher for longer regime from the perspective of monetary policy in terms of the Fed and other central banks really pushing back on any expectation that they're going to be lowering rates or doing quantitative easing at any point in time over the next, kind of 18 months or so. So we'll get more clues on that, hopefully from Jackson Hole. If not Jackson Hole, more than likely the next series of Fed, ECB, Bank of England meetings, et cetera, et cetera. And then lastly, industrial metals bearish FAMs got about 2% upside, 5% of downside. So with that, Darius Dale presenting our macro minute for Thursday, August 25th, 2022. Best of luck out there today. Cheers.